Good afternoon and happy Friday from the Shreveport office of Eagle Financial Management Services for another edition for the June 11th, 2021 edition of the Jack and Bill Show. So, how do you catch a unique bird?
Not tell bad jokes.
You sneak up on it. That's actually how I found my wife. Okay. You don't like that one? Stacy won't appreciate that at all. Okay. New record for the S&P 500 today. S&P 500 on a total return basis was up 13.6% through yesterday. And just to confirm that, the last I looked with about 5 minutes to go, we were up about 7 points. That's about 0.2%. So we're up about 13.8% year to date, Bill. I can't verify that because there's a commercial on Fox Business here. So stocks, here we are at just about halfway through the year, and stocks have had more than a year's worth of returns. Typically, historically, about 10% a year. The high quality bond market, though, is still down about 2% year to date. However, in the last few weeks, and I don't get this, Bill, but the 10-year Treasury note yield and the 30-year Treasury bond yield have come down a little bit. That means prices have gone up 1.46% on the 10-year. Very unappealing to us from an investment standpoint. And 2.14% on the 30-year bond, also very unattractive and difficult to understand given some of the news that we're seeing that Bill's going to lead us through a conversation here. This is this morning's Wall Street Journal with the number one headline here saying inflation jumps to 13-year high. So West Texas Intermediate closing at $70.80, the highest level we've had since 2018. That's up 51 cents a barrel, or call it 0.2%. Gold down a little bit, $18, about 1% today, closing at $18.78. Silver up a fraction, closing at $28.07. That's up 50 to 60% in the last year. But interestingly, to go along with this conversation, you know, Bill, I was talking to a gentleman that owns a paint business. They were painting at our house this morning, and he had to go buy a 16-foot long 2x4. And a year ago, they cost $14, and today they're $46. So, in fact, I had someone send me a joke this morning that it's a picture of a pile of lumber saying, today U.S. Customs seized $1.7 million in lumber being smuggled in shipments of cocaine. Anyway, that's a joke, too.
Better than the first one.
Better than the first one. Okay. So, since kind of giving some of the major indices of the market closing today, take it a step farther and talk. The Dow Jones Commodity Index is up 23.4% year to date. West Texas Intermediate is up 45% year to date. We're really starting to feel that at the pump. Natural gas is up 24%, and 2x4s have gone from $14 to $46. So Bill, what is it that we're going to chat about today?
You know, this headline right here, you know, this is what really says it all right here. And we had some feedback last week from a viewer about inflation and how best to position an investment portfolio in the midst of rising inflation. And we thought it was a really terrific question. It's a timely topic because that is the big question of the day in financial markets. Are we entering into a new macroeconomic regime of inflation, or will we continue in this disinflationary, borderline deflationary environment that we've been kind of stuck in since the 2008 credit crisis? But the inflationary numbers, were expected to be elevated, and there are reasons for that. The big one being that the economy was locked down last year because of COVID. And so with the economy reopening and the supply bottlenecks that we've been seeing, and anecdotally, lumber prices is an example of that, it shouldn't be a surprise that we're seeing these big inflationary number prints. But 5%, year over year inflation, that's the number for May, year over year. That's a big number. And, some in the economic community will say, well, that's a headline number. If you strip out, food and energy, that's really a better reflection of the inflationary environment. Well, core CPI, which strips out food and energy, was 3.8% year over year. And I don't even know if that's really that relevant anymore, because, people do have to buy things like food and energy. And those are the things that people are most concerned about: gasoline, food, housing. Maybe that's not important, for the academicians, but it's certainly important for those of us that live on Main Street, so to speak.
I think the headline is, though, this is the worst inflation in 13 years, Bill.
This is. But the big debate going on right now is this temporary or is this sticky? Is this going to continue? So as I mentioned, we shouldn't be surprised by the big numbers, because as we're opening up the economy and we are seeing supply bottlenecks, we are in a situation where demand is outstripping supply, and that causes price increases. We're certainly seeing that. But, there's another side of this too. And there are people on both sides of this argument, very, very smart, reputable people who are taking very strong positions on both sides. And for those who are not concerned about inflation, they're the ones who are saying, don't worry about inflation, it will pass. They're pointing to some, viable things like, for example, the fiscal stimulus. Okay, fiscal stimulus is coming to an end. So, these fiscal stimulus checks, they will not persist. And so that in and of itself, could put a damper on inflationary growth.
I think the biggest thing, Bill, is people going back to work.
Well,
okay,
true.
So if I've always heard that, which I believe this is factual, that about 2/3 of all inflation comes from increases in unit labor costs or the labor force. And that's, what is inflation? It's just a general rise in prices. Well, we've got people that have gotten used to staying at home. They're not in a hurry to go back to work because they're getting more than they can get working at McDonald's or local restaurants, or their manufacturing jobs. And so we're seeing those costs, passed on. And I was listening to an analyst say that, that's not so bad for consumers if they're getting pay raises. But if the inflation is coming through commodity prices, it's much harder for people to, weather the storms because the incomes don't keep up.
Yeah. And, I could poke some holes in that argument, because, the people who get hurt the worst in an inflationary environment are people on low and or fixed incomes, because they're spending a greater percentage of their household income on necessities, food, gas, housing. And that's where you're really going to see the price increases. So I don't necessarily agree with what the analyst was saying.
That was my point. If that's coming from commodity price increases, that is going to hurt the people that aren't getting the wage growth increases to offset some of this inflation.
But yeah, I mean, so like I was saying, one of the things is that we are seeing, we're coming to an end in the transfer payments from fiscal stimulus. There's another big one that those in the don't be worried about inflation camp point to, and that is China. China is the world's primary supplier, and we are seeing China slow production. So, if we're seeing production out of China slow, that could be a reflection of future demand dropping off. But, we'll see. Now, Jack, you mentioned something that's perplexing in all this, and that is, what the bond market is saying. The bond market is basically saying that inflation is transitory. So with a 10-year U.S. Treasury yield at 1.5%, that's not an inflationary yield. A 30-year Treasury bond at 2.1%, no. So, the bond market is clearly not worried. Proxies for inflation expectations, those would include TIPS break-evens, CPI swaps. I mention those just to say that there are things that we can look at in the financial marketplace that can give us some guidance on inflation expectations. Those are two big ones, and their pricing levels are very low right now. But
the bond market would be forecasting arguably deflation. We don't have that at all either. But we're at a 1.46 10-year Treasury note yield because it's been artificially driven down there.
Well, that's true.
So
it has been manipulated.
The Federal Reserve is purchasing Treasury securities every month. So we've got keeping the yields lower and lower and lower.
But something's going to have to give here, because the bond market is saying one thing, and other areas that we can look at are providing conflicting evidence. But we have this big gap right now between the 10-year Treasury yield at 1.5 and CPI, which came in at 5%. That's a 3.5% gap between the two. And that's the largest gap that we've had since 1980.
Well, what's the significance of that?
Just what I said. Something's going to have to give.
No, I think there's another point too, Bill, and that is for anyone who wants to purchase intermediate and long-term bonds in here, you have to pay taxes on that, unless it's held in a retirement account, and you're getting less than the inflation rate.
That's correct.
So you're moving way behind with these bond yields where they are.
Well, that's right. I mean,
artificially low.
The real yield, meaning net of inflation, on the 10-year Treasury, if you're getting 1.5% on your 10-year Treasury, 5% CPI, your real yield is minus 3.5%. So the only reason why anyone would buy a 10-year Treasury is if they think that rates are going lower in the future.
Or we're going to have deflation.
Correct.
Those two things.
So something's got to give. We have the clearly mixed signals here. And, we're seeing mixed signals even in equities. Take energy and metals equities. Normally, you would see these things moving significantly in advance of inflation, with inflation expectations moving higher. And yeah, we have seen a nice rally out of energy and materials since the fall. But even after that rally, we're still seeing energy and metal equities trading at very, very big discounts to the broad market. Another thing we can look at in this context is long duration equities, growth stocks. Normally these long duration growth stocks don't do very well leading into inflation, but yeah, they've been lagging a little bit year to date, but they're still very, very overvalued. So I think, this is just my opinion, I think that the jury is still out. There are certainly anecdotal things that we can point to. There's certainly areas in the market that are sending inflationary signals, but there are also areas in the market that are not sending inflationary signals. But I think that one of the things we need to be concerned about on the inflationary front is what the Fed is doing. And the Fed has expressed a willingness to let the economy run hot. And one thing we do know about the Fed is they're always slow to respond. And it wouldn't surprise me if inflation gets out of hand before the Fed steps in and does anything about it. And another thing I'll point to is the self-fulfilling nature of inflation, because everyone's talking about it. And if we do see changes in consumer behavior, meaning people run out and start buying big ticket items now, but because they're concerned about prices going higher in the future, that can serve to accelerate the inflationary growth in the economy.
Well, Bill, I've got a visual aid for that. And this is a little bit dated, but that's okay. I found this back in the office for a seminar that we did back a long time ago. But this shows, this is Roger Ibbotson and Associates, Stocks, Bonds, Bills, and Inflation. Can we see that okay, Wesley?
No, we cannot.
Oh, we can't see it?
All right, we'll take our word for it.
Okay. If, can you see these lines at all here?
Well, you're holding it off screen, so no.
Okay. Can you see them now?
Yes.
If you look at CPI inflation, if you indexed it starting at $1, inflation, we see here that long-term government bonds, 20-year U.S. Treasuries bill, the return on inflation was exactly the same as 20-year government bonds from 1925 all the way to the year 1980. So that means, and then, then we had this divergence. So this would be my big question is that if we're entering into a period like this, you can think about this. Inflation since 1925 has averaged about 3% per year. It's been a little bit lower than that the last few years. It is the goal of the Federal Reserve to keep it around 2% and to have maximum employment. But the return on T-bills and the return on long-term government bonds all converged right here in March of 1980 when we got into runaway inflation. And so that's what I think is one of the biggest points of all this is, does inflation matter and what are the consequences of high inflation? And, I know of people that were buying long-term tax-free municipal bonds in the mid-70s, and all those things, including government bonds, they were priced for 50 cents on the dollar.
Oh, yeah.
When we got to March of 1980, and we had Fed Chairman, the cigar smoker, come in and get things back on track by dramatically raising the Fed funds rate, I think all the way up to about 16 or 16.5%. So then we had mortgage rates got up to 16 to 18%. And so then we've been in a secular, think seasonality, cyclicality, the business cycle, secular, very long-term trends. The bond market has really had very long-term or secular moves. And you could say that we've been in a decline in interest rates since that period in 1980. And a lot of people wonder, have we seen the end of the bond bull market? And I think, the thing about signals we're getting from the bond market, if you look at it on a, not just what's happened in the last week or two, but what's happened in the last year, bond yields are dramatically higher, even more than doubling from where we were
off the pandemic lows.
Off of the pandemic lows. So we've had an escalation in bond yields, and I don't think on a long-term basis, bond yields need to trade higher than CPI inflation or otherwise you move backwards. So,
There is a big difference between today and the late 1970s. And, and everyone can point to Fed Chairman Paul Volcker and what he did. Well, it's really in conjunction with the Reagan administration and just breaking the back of runaway inflation at that time. But, he did it by raising interest rates. I don't know that we have that luxury today because the Fed has benefited from artificially low interest rates in terms of issuing more and more debt, or I should say the Treasury Department has. Well, if we start normalizing interest rates to, let's just say, to a level where they should be given CPI, I don't know that our government could afford the debt service. So, now we're in this very, very difficult situation where we're really backed into a corner here. We really cannot afford to fight an inflationary battle because that would require raising interest rates, and we cannot afford to do that.
I totally agree with that, Bill. And I think that we're ultimately going to find our place where the markets determine prices and yields of all commodities, of interest rates. And we've basically got the government determining, bond prices right now to some degree.
Well, yeah.
So,
but we'll see. I don't want to be, trying to predict, making big bold calls on interest rates and inflation. There are smarter people out there than me that are doing it, and they're generally wrong. But rather than focus on predictions, why don't we talk about what people should do if they want to protect an investment portfolio against rising inflation? Because if we do get into an inflationary environment, there are things that will work better than others, and it does require making adjustments.
were you going to talk about buying cryptocurrencies?
No.
Okay, well, what can we do then?
I could get off on a tangent. Well, I'm not going to do that. But, generally, equities do pretty well in an inflationary environment. I think the problem with equities is that if we see inflation really steepen and increase rapidly, that's when equities can stumble. But equities generally tend to do very well. And I would say that if you're going to have equity exposure in an inflationary environment, focus on companies that have the ability to pass along rising costs. Okay, those companies will be able to protect their bottom line better than those that cannot. Also, look for companies that produce products and services that are price inelastic. And what I mean by that is that the demand for those products and services will stay the same regardless of increases in prices. Now, in looking at stocks and evaluating, stocks to invest in, focus on dividend payers. Okay, those companies are short duration, assets. Those stocks, I should say. So those tend to do better than the longer duration equities, meaning those that pay no dividends. Look in certain sectors, natural resource stocks, okay, energy companies, metals, miners, those types of companies. If you took, and this is based on some research from the asset management firm GMO, they identified that a basket of energy and metals equities kept up with or beat inflation 6 out of 8 identifiable periods in U.S. history when CPI inflation exceeded 5%. So historically, that sector has worked.
Yeah, Bill, and I would, if you're talking about inflationary periods that exceed 5%, which is basically the number that we got
right there
yesterday, and the shadow inflationary numbers
higher.
Are higher. I mean, think, healthcare and food and energy. I mean, energy prices, gasoline prices are up 50% so far this year. But that would be a climate where the stock market would not do well. and I think this would be a period where we could say that it would perform extraordinarily poorly because of what our central bank has done to move interest rates all the way down to zero. So these stocks have been propped up by low interest rates. And if we do have inflation and we do have a Federal Reserve that, the biggest tool in the toolbox to keep inflation from running away is to raise short-term interest rates and, to try to slow things down. But the stock market is now a long duration asset. So, so we do need to look to, as you're saying, other sources of returns. And we as a firm have done that. We were positioned before the start of the year with a greater than a market weighting in energy and natural resources and higher income dividend paying stocks.
Yeah, equities.
Defensive names as well in the equity arena. Things that by defensive, not to be confused with defense stocks, but defensive names are things like food, tobacco, beverages, alcohol, drugs. Think big pharma. A lot of these have
Inelastic demand.
People are going to buy those things no matter what. Those are the you're gonna buy your pills and your food, before you buy other things, luxury items.
Dog food.
I'm not sure about that.
Oh yeah, people will spend money on their pets. Look at West.
Oh yeah. Oh, I mean,
gosh.
I thought you meant before dog food. No, not at my house.
And his cat.
My dogs get fed before I get fed.
Hey, Wesley's cat lives a life of luxury. That's all I'm saying. Now, outside of equities, there are other things that people can invest in an inflationary environment. Precious metals is an area that gets pointed to very frequently, and the track record it's not as clear cut. Maybe the caveat that we ought to disclose when it comes to precious metals is that the forward commodity prices, really should already price in inflation expectations. But I like precious metals, for a portfolio if we're expecting inflation. Now, when it comes to fixed income, that's a trickier area because, as Jack was talking about, rising interest rates, not good for the bond market because there's an inverse relationship between rising interest rates and bond prices. So when rates go higher, your bond that's paying a fixed coupon is now worth less. So if you want to have bond exposure, and everyone needs to have some bond exposure, there are areas that you can focus on that can protect you. One is Treasury inflation protected securities. These are U.S. Treasury bonds that have a built-in mechanism to adjust the principal of the bond as we see changes to CPI. So that's a direct hedge on inflation. If you want some other protection, you could look at adjustable rate bonds. Okay, so these are securities where there's an adjustable coupon. But we would also say keep your duration shorter. The biggest risk for bond investors, if we're seeing rising inflation and rising interest rates, is being stuck in a long-dated fixed rate bond. You will get absolutely killed.
Yeah, absolutely. And we've done that. We don't own many bonds over 5 years in duration here. So you can protect yourself with your muni bonds too by owning callable, higher coupon, what we call cushion bonds. So for anyone out there who thinks that rates may be going higher and you don't understand cushion bonds, give us a phone call. So we can cushion or dampen the volatility or the price movements in a rising interest rate environment. You can actually purchase cushion bonds that are with, say, 2 or 3 year, 2 to 5 year call dates, maturing in, say, 10 or 12 years. And if rates go up, the bonds will actually yield more if they make it to maturity than being called in.
That's right. Well, I'd say to summarize, there is a lot of talk, not just in financial media, but in mainstream media about inflation and inflation risk. That will continue to be the topic du jour. There does seem to be a consensus in some areas, a different consensus in other areas. I wouldn't get all wrapped up in that. Just be aware. We'll know more as data comes in, but it sure doesn't hurt to do a little preparatory work in an investment portfolio for what may come, which may be higher inflation. So we're here to help.
Yeah, Bill, I would say that, if the Dow Jones Commodity Index is up 23% plus this year, shouldn't you be participating in something like that to be in the flow of the markets? So if you own those things, like you mentioned, silver's up over 50% in the last 12 months. West Texas Intermediate, you've got to have some energy exposure. And that seems like a no-brainer to me. Or if you think natural gas prices are up 24% year to date, why would natural gas prices be up so much? I mean, think about, I think, isn't it by 2035 that all the vehicles on the road are supposed to be electric? I mean, we only have half of the power in the United States from the grid to be accommodative to these kinds of changes that we foresee coming. And it's going to be natural gas fired power plants that is the greatest source of energy to run these electric utilities and provide electricity for these F-150 Ford Lightnings and Tesla Model S's and whatever the vehicle of the day is. So I tend to think, I'm with Bill. We try not to make huge macroeconomic decisions. We try to live in today with our portfolios and feel like you really do need exposure there. But, why take the risk in long dated fixed income too? There's no money to be made in that and a lot to be lost in it. Bill, it's interesting. We spent 2 weeks talking about cryptos too. And I view that as an alternative to some of the low yielding fixed income. But in today's yesterday's Wall Street Journal had a story that Bitcoin has been deemed legal tender for the nation of El Salvador. That's a pretty strong step. And here we go today, one of the largest providers for 401k plans, For Us All Inc. That company has struck a deal with Coinbase Global, a leading cryptocurrency exchange that just went public about 2 months ago here on the New York Stock Exchange, to allow participants in their 401k plans to put upwards of 5% of their money into Bitcoin. So that's now, I think as we see news like that, you're going to continue to see that countered by central bankers and world treasury departments, governments, wanting to stop this thing as well. So,
we saw where the U.S. government was able to successfully seize cryptocurrency taken in a ransomware attack from Colonial Pipeline, and that got a lot of people scratching their heads because the cryptocurrencies weren't supposed to be traceable. So now we know that governments can actually go in and track that stuff. Interesting. All right. Well, enough of that. It's
Sports. Hold on.
no, enough of that.
We've got. I've
That's
got
right.
my LSU coaches track and field shirt on. I'm not going to be doing any coaching, but the LSU men shortly take the field at Tracktown, USA, Eugene, Oregon, home of the Ducks. Their brand new facility, one of the top venues in the world. And the LSU men are looking to take the title this evening. Hopefully there's rain in the forecast and cool temperatures. SEC athletes are not crazy about that. Bill, we've also got the super regionals for NCAA baseball going on. There's 16 teams remaining. 8 make it to the College World Series. Those eight teams will be determined this weekend, and there are still 6 SEC schools remaining. So we've got those are my favorite sports on the docket, and someone's trying to call me. So I think it's time for us to call it a wrap. And what are we talking about next week, Bill?
I will not be here, so you get to come up with a timely topic of your choice.
Okay. Okay. Well, there you have it. Make good decisions this weekend. If you have any questions, give us a ring or ask us a question on Facebook, and we will see you next Friday.